following podcast was recorded on Tuesday, February 8th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Thank you.
Today, Sam will be discussing the jobs report, inflation, and the Fed hike. Sam, last week we had a very strong jobs report with a record number of people calling in sick. How does it change the dynamic with the Fed, if at all? What is their stance?
It's really interesting, right? So we were all expecting this very, very, very poor January jobs report. Omicron was going to have this devastating effect. And thanks to a seasonal adjustment, it just went away, which is interesting. The non-seasonally adjusted numbers were pretty much as bad as they typically are for January. You almost always lose jobs in January, and by almost, it's pretty much a guarantee that you're going to actually lose jobs in January, but the seasonal adjustment takes care of that. So we were down about 2.8 million. 2.8 million is about what you would expect for a normal January, but seasonal adjustment picked it up perfectly fine, etc. So you still had a seasonally adjusted 300K. That's a pretty big number, particularly when most people were quietly talking about minus 300, minus 500. Pretty big negative numbers for the January jobs report. And one of the pieces of the puzzle that I think the Fed is probably looking at with a little bit of a grin right now is that you had a record number of people calling sick. So 3.6 million, a little over that, called in sick during the forecast or during the reference period when they take the survey. That's a lot of people. That's the most we've ever had. The Fed's looking at that and going, well, wait a minute, those are going to be back at work for the February jobs report. That's going to be a significant tailwind to the labor market, not a headwind. That's going to be a really big number in February, potentially, or at least going to significantly distort what we would normally expect to be a strong month for job creation in February. So I would say this is kind of a confidence booster to the Fed. It's going to say, hey, listen, we knew that we were getting close to full employment. Now look at us. We had 3,600,000 people calling sick, and we still had a good jobs report. That's going to give them a little confidence as we head into February and March.
So let's talk about what does really matter to the Fed. Is it inflation expectations, realized inflation, and specifically, I'd like to know, is there a correlation between age and inflation expectations? And if so, why does that matter?
Yeah, so it's not about realized inflation anymore. The Fed knows that it really can't take care of realized inflation. Realized inflation is a combination of supply chain issues, energy, food, et cetera, right? The Fed can't magically make more energy, it can't magically make more food. But what it can do is it can actually affect the expectations for inflation going forward. And this is one of the most interesting charts, I think, out there on inflation. That's breaking down 3-year inflation expectations by the age demographic. So 60 plus, 40 to 60, and under 40. The under 40 crowd doesn't really see inflation as being that big of a deal. It's still well anchored. Right around 3.5%. The 40 to 60 crowd, they were becoming unanchored. They were becoming a little unhinged, going to 3-year inflation above 4.5%, but they've come back down recently. It's that 60 plus crowd that's really anxious about this inflation picture, sitting at about 5%, continuing to move higher. But that's really disconcerting for the Fed on some level. Because those are the ones that remember the last time we had an inflationary environment, right? The last time we had a significant environment of inflation pressures was about 40 years ago. That's when the 60 plus crowd was in their prime. That's that's still stuck in their mind as a significant problem, right? That was a monetary policy error in the 60s that spun into the 70s and 80s. It's going to continue to be a problem for the Fed unless they begin to tighten policy. And by tightening policy, they can actually begin to affect these expectations. They can't really affect the realized inflation numbers coming out in, call it March, April, May, but they can affect the expectation for what's going to happen down the road. And I think that's a particular reason for the Fed to continue along the tightening path. Right? We already have a good jobs report under our belt. We need, the Fed in their mind needs to get the inflation expectation not only under control, but back down to a reasonable level over a moderate time horizon.
So speaking of tightening, if we turn next, there's a debate right now about if the Fed will hike 25 basis points to 50 basis points in March. But what does this debate miss?
It misses the fact that we don't hike by 25 or 50 anymore. What we do is we hike by ranges. So we're at 0 to 25 right now, and we're sitting at the bottom of that range. So we have an 8 basis point effective funds rate at the moment. That's not the midpoint of the range, which would be 12.5. We're sitting at 8. And whether or not the Fed decides to raise one range or two ranges, which is really the debate I think we should be having if we're going to have a debate about that at all, it has a number of different places that it can actually put that effective Fed funds rate, right? It can target that pretty closely. So if it raises one range, if we think about that for a moment, from 0 to 25 to 25 to 50, there's an awful lot of room in there to either be a little bit dovish, right? You can put it at 27, 28 basis points just above the effective range or the range bound, the lower bound, or you could put it near the top, right? You could put it at, call it 45 or 40. And if you put it at the top of a 25 to 50 basis point range, that puts it at, let's call it 45 basis points. That's a 37 basis point hike. That's a pretty large move. So it's like 1.5 normal hikes, but you only hike one range. That's a pretty effective signal for the Fed that while they didn't go two ranges and set it at the midpoint or set it at the bottom, whatever it might be, that it was willing to really move the needle in terms of tightening policy. That's really the debate I think we need to be having. Is if the Fed hikes one range, where does it set actual policy? And if the Fed hikes two ranges, is it going to put it at the middle? Is it going to put it at the bottom? Right, that would be, call it a dovish 50 basis point hike by our standards. That's the debate I think we should be having right now. Is not, is the Fed going to go 25 or 50? I think that misses the way that modern monetary policy is actually conducted.
So in summary today, Sam, what are your thoughts with the CPI print being released on Thursday?
I think that's actually one of the more interesting CPI reports that we're going to have probably for the next decade or so. It's the one that's going to really tee up whether we get one range, two ranges, et cetera, of tightening going into March. I think that's really going to be one of the more important ones. But I don't think it matters in terms of the direction of overall tightening. The Fed is going to tighten. The Fed is really, at this point, probably trying to figure out exactly how much they can do without breaking the economy. And one CPI report really isn't going to matter that much. But it could signal, call it whether inflation is likely to begin coming down. We're going to have this weird benchmarking, similar benchmark revision, similar to what we had with the jobs report in terms of a shift of the overall weightings and in terms of a shift in the metrics for CPI that is going to potentially have a moderate effect, depending on exactly what those come in at. The 19 to 20 benchmark is going to be different. It's going to be a little more goods heavy, a little less services heavy. That could actually become not the Fed's friend in terms of a reading. So you could get a little hawkishness sentiment coming out of this. So it'd be interesting. It'll be interesting to watch the long end of the curve if you begin to have significant hawkish sentiment on the CPI report Thursday.
Well, thank you, Sam, for your thoughts today. As always, thank you everyone for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For any questions, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.